Lehman Brothers collapses after betting on toxic debt. Parts of it are saved by a British bank, which plans to splash out $2.5 billion in bonuses on the very bankers that brought the US giant to its knees. Were no lessons learned from the financial turmoil? This is Inside Story. Hello, I'm Stephen Cole, and welcome to this special edition from Inside Story in London. A crisis in the US housing market balloons into thousands of job losses in the European property and banking sector. More could follow after a week of turmoil in the financial markets. Trouble was brewing as long ago as late last year. In scenes not witnessed in the United Kingdom for more than a century, thousands queued outside a bank to withdraw their cash as Northern Rock teetered on the very brink of a collapse.
For some time, this has been the decadent decade, swept along on a wave of ballooning property prices and a wave of debt from the British government to new homeowners. No one thought this party would end. London's financial district came to symbolise Britain's newfound wealth.
In London, like many other financial centres around the world, the markets are in crisis. Banks have lost billions and their staff are now surplus to requirements.
US investment giant Lehman Brothers collapsed, leaving thousands in its London office unemployed.
The whole financial industry does seem to be in a very bad shape right now. So there will be tens of thousands of people competing with me on jobs.
Britain's $7 trillion housing market is grinding to a virtual standstill as banks repossess homes at their fastest pace in more than a decade. And as the gloom descends further, the UK Finance Minister warns the global economy faces its worst economic crisis in 60 years. The implosion began with the first run on a British bank in more than a century. Thousands queued up to withdraw their savings at Northern Rock, as it became clear it couldn't raise new money to pay older debt. The British government stepped in, nationalising the bank in February this year. It may have seemed as though this was a one-off until the extraordinary events of last week. As the US rescued insurer AIG and let Lehman go to the wall, banks stopped lending to each other, and central banks pumped billions to prop up the ailing markets. Speculators began betting on the next Northern Rock to go under. The UK's premier mortgage lender HBOS came under pressure. The government had to organise a $22 billion takeover by rival Lloyds TSB. The British economy is tightly bound to house prices, and the current economic downturn could have serious consequences.
When house prices are booming, people feel much richer and they spend more, and they're also able to borrow more money because when you've got an expensive house, you can remortgage your house. And effectively what that did was inflate a massive bubble, which is now bursting, and that's why we're in deep trouble at the moment.
But it's not just Britain. Back in January, Gordon Brown welcomed European leaders to discuss Europe-wide financial worries. Every country has been hit in some way. Germany has bailed out state-owned banks with taxpayers' money after they gambled on subprime debt. Some countries have been hit harder than others. Spain, for example, whose economy was once the envy of Europe. It joined the Eurozone, interest rates were at historical lows, credit and construction boom followed. But now the economy is on the brink of recession as unemployment soars to a 3-year and inflation soars to a 15-year high. Ireland too, once known as the Celtic Tiger for its roaring economy, is now in recession and enduring the highest unemployment in a decade. Experts describe this as a global economic crisis, but one that affects different countries in different ways.
European countries and countries all over the world that saw the fastest and most explosive growth in house prices are going to be hit harder than other countries. But other countries like Germany that didn't have this housing bubble are still suffering.
Following the Lehman Brothers collapse, the European Central Bank made a €100 billion injection to keep the money markets functioning. At the same time, the Bank of England has pumped in over £25 billion. But in a world where confidence is everything, right now there isn't much of it going around.
The US credit markets may have been a poisoned chalice for European banks such as Northern Rock, but it didn't stop there. What started as a ripple in America has now spread to other international economies. Fergal Parkinson, Al Jazeera, London.
So, the bubble has burst. The good times lasted almost 20 years, but do all good things have to come to an end? And how much of the crash was inevitable because of rampant speculation? The British Chancellor says there are bumpy times to come for the British economy, the fourth biggest in the world. And now some European governments are facing stark choices between cutting government spending or putting up taxes, or both. Well, with me now in London to talk about the credit crunch in Britain, Europe and Russia is Alistair Heath, and Alistair is the editor of Business City newspaper, and Justin Urquhart-Stewart, director of Seven Investment Management. Let's open with the easy one, gentlemen. Were the bankers to blame for lending money to ever riskier borrowers? Justin.
Well, the person who does the lending is obviously the one that bears the responsibility. But like all these things, it's not just one set of individuals, it's a whole combination of elements. And certainly when you look in Britain, you can see just as well as the regulators, in terms of the politicians, as well as the bankers, all are actually culpable in this. But we have been through a boom, which has been seeing us through for 16 years, and after 16 years worth of boom, where the final word was one of complacency, you're going to get a bust, and that's inevitable.
Alistair, Justin won't name any names. He's indicted the whole lot, in fact. What about you?
I think I get to name one name in particular, and that's Alan Greenspan. For me, the biggest culprits here are central bankers. In the late 90s and after the dot-com bubble and 9/11, central bankers massively inflated the global economy to try and prevent it from sliding into recession. And while at the time everybody thought they were doing very well and this was a clever thing to do, what it eventually did was fuel a massive, massive bubble in house prices and other asset classes. And that is now bursting. And other bankers, people who work for places like Merrill Lynch or Lehman Brothers and so on, were responding, they were reacting to the cheap money, the cheap funds provided to them by the central bankers. So obviously they are to blame too, but the real culprits here are the authorities and central banks in particular.
And central bank in particular in America, Justin. Alistair's blaming Alan Greenspan. He does love the idea, or loved the idea of loose money, didn't he?
Well, that was the policy that he's had. Not only loose money, but also every time there was a problem, you'd hear the US cavalry coming to the rescue to come and pick up any of the problems that were there, and thus maintain the party. And that has been the issue, as opposed to actually saying these particular areas are failing, these banks are failing, and letting them go, rather than actually building this up to this pinnacle we're seeing now, which has created such a disaster. So it's a combination of elements. It is not just any one single one, but certainly when you get down to the bankers designing products that people don't understand, including themselves quite often, then certainly that has been a key element.
Alistair, people didn't understand the risks they were taking. Are we talking bankers here now, or are we talking traders? Who are we talking about?
Yes,
are we talking customers?
I think everybody, really. I mean, ultimately, people believed their own propaganda.
Did anybody understand what was going on?
Well, I think they sort of understood, but they convinced themselves that everything would be all right. That's what always happens when you have a bubble. You know, prices of something just goes up and up and up and up, and everybody who jumps in becomes rich and rich and richer. And if you stay on the sides and sort of criticise what's going on, you're wiped out because you're not making any money, and everyone sort of criticises you and so on. So everybody after a while started to believe that risk had fallen and there was virtually no risk left. They thought you could diversify it away, or they thought people would never default on their mortgages. They thought the global economy would continue growing forever, perhaps the Chinese would always bail us out, and so on and so forth. People believed all of this, you know, everybody was guilty almost.
Hold on a second, gentlemen, you're naming everybody here. What about you two?
Oh,
did you know anything about what was going to happen?
Well,
did you forecast anything?
I can actually say with some direct honesty that my chief investment officer did. And she warned us clearly, and I have to say, I didn't believe her. So I'm the fool here, not her. And she was the one
amongst many.
So she turned around and said, this is too risky. And what was the clue to her? She didn't know when, she didn't know where. But as far as she was concerned, she actually looked at it and said, some of these Wall Street houses, and to name one, she was actually looking at Merrill's, she thought probably wouldn't be there in 18 months' time. And what was the trigger, or what was the issue she was looking at? And the answer was risk spreads. The spreads that were there did not make sense. And what it was...
Just to stop you, sort of, just risk spreads, in English, if possible.
If you look at high-quality bonds, AAA bonds, they will have a relatively small risk on them, risk spread on them, because it's high-quality stuff. If you're buying BBB junk bonds, then you expect the spread to be wider, because you're taking on more risk, you expect to be rewarded for that. If junk bonds are now being valued virtually the same as quality bonds, something's wrong. Either suddenly all these junk bonds aren't junk anymore, everything is wonderful, or there's something and you should smell a rat. And that's exactly what she was smelling there and saying, this doesn't make sense. And so we went through all our asset allocation work. They were able to say, look, I'm sorry, this is too risky, take money off the table.
Yes, absolutely. I mean, I can't say that I forecast what particular investment bank will go down, unlike Justin, but for years it was clear to me that central bankers had fallen foul of a massive intellectual error. For example, in Britain, Gordon Brown, who's now Prime Minister but who was Chancellor, set up an independent central bank. Now, that was a good thing to do. But his terrible mistake was to order that central bank only to focus on consumer prices. That meant that when there was very little inflation on the consumer price index, thanks to all these imports from China and other developing countries, it seemed as if everything was okay. Brown was convinced that stability was here forever.
I find it bizarre, and so do many, many ordinary men and women, that these huge experts, these fat cats on millions of dollars in bonuses, none of them forecasted. All the expertise in the city. The city is the greatest part of the financial institution in the world, and nobody knew. Nobody could see this.
Because if you're in a situation where everybody is actually moving in one direction, it takes a brave individual to pop their head up and look round the other way and say, actually, this is probably wrong. Now, some people did, but not many. And bear in mind, people's reward structure is in going with the flow. Not many people are rewarded for going in the opposite direction when you've got that tide heading in that way. And so it was inevitable. Then you've got the regulators not understanding the risk. And so that whole element, therefore, becomes effectively self-assuring. Everybody else is doing it, therefore we must be okay. And it's fundamentally flawed. It happens on a regular basis, normally every decade in banking.
Okay, so a shakedown. Alistair, you've heard me try and pin some blame somewhere, because people want to know whether blame should be aimed at. The buccaneering CEOs, these fat pension pots, why should they be allowed to get away with this? Where does the buck stop in the city?
I mean, a lot of people have been wiped out. Okay, so a lot of people have lost. I mean, there's this belief that no one's lost out except for ordinary people. Ordinary people are in the process of being hammered, and they're going to be hammered much more badly over the next year or two.
Through their pension funds.
Through their pension funds, through the whole economy slowing down, through house prices collapsing. But a lot of the people responsible have been wiped out also. Lehman Brothers, right? 30% of the shares of Lehman Brothers were owned by Lehman Brothers employees. A lot of the compensation, all the stock options, a lot of the wages and bonuses were paid in shares. So these people have gone from owning 5 million, 10 million, 20 million to nothing in many cases, or losing a huge bulk of their fortune. So in that case, at least, a lot of the people directly responsible have been wiped out.
So just add a bit on the politicians there, is that they've also allowed this to carry on. What was the great growth of the UK economy? The answer is, well, there wasn't much. What it was consumer spending and government spending, and that's all based on debt. There are two pillars to the British economy: government and consumer spending, or government and consumer debt. We've now got a huge level of personal debt, which your average British household is not very capable of actually managing very effectively. So effectively, we had a big blister on our toe. The toe's got bigger, the blister's bust. All you've now got is a rather painful toe, which is a little bit bigger because it's painful. That, I'm afraid, is all we've created in 10 years.
This crisis started just under a year ago. Why is it taking so long to play out?
You have to almost look at this as a bit like sort of the nuclear warnings. You go from DEFCON 5 up to DEFCON 1. DEFCON 5 was last year when you had the credit warning in the first place. Then you had the liquidity going in for number 2. Then you actually had people swapping paper for Duff bonds, so they can have gilts and treasury stock. Then on DEFCON 4, you actually saw the government, so the central bankers having to go in and provide absolute support. Now welcome to DEFCON 1, where we're actually in a situation where they're having to actually bail it all out.
Alistair?
In general terms, if you're a banker, if you're a fund manager and so on, and if you're not doing as well as your peers because you step back temporarily from the bubble, you'll end up getting fired. So you've got this horrible paradox where the best people, the people who actually know that everything's going to go wrong, get sacked. And the only people left are the people who are, who've fallen prey to this crazy bubble.
All right, Alistair, we'll leave it there for the moment. Alistair and Justin, we've talked about .com, or hinted about .com. I'll come back to that in a moment. And we've also talked about Britain, but not Europe yet. Tax rises, some say, are inevitable, and job losses too. We're going to to take a short break now. When we come back, we'll talk more about the fallout from the financial crisis in Europe. So stay with Inside Story.